we start every show off with a summary of kind of what we saw happening in the market this week. And it's been a really kind of exciting time to be an investor the last few weeks. And I'll use this view here to start with, so you can kind of see, what's happening. A little bit of a different chart to start off the summary with. I usually start off with the S&P 500, which we'll get to, but this just shows the rate of return by week going back to, looks like, late 2021. And really, it's kind of when the market peaked out. We had a great run for 20 and 2021. Then they started talking about, raising interest rates, and we started to see, some of these negative bars come in 2022. But the last 3 weeks is pretty unprecedented in this time frame. If you look, we had nearly a 6% return 3 weeks ago. And really over the last 3 weeks, as we sit here, roughly about a little over 9% return in 3 week period. Now, you have to put that into context. If you look, there was a couple of down bars 2 weeks in a row that came just before this. But also, the S&P 500 averages 11% a year over the long term. So having a 9% return is a spectacular thing. And I really operate under the concept of momentum, which is this, that once a body is in motion, it tends to stay in motion. And there's some friction here, and it'll eventually slow down and what have you. But, we have had a phenomenal run here that's probably not going to disappear tomorrow.
Yeah, and you can just look at that magnitude of those bars too. They're bigger. Like that week is just that massive compared to everything else.
Yeah, it was stunning to me. I just thought that was the most incredible thing. And it's not super surprising in the sense that, at that time there were so many people saying the market was going to go much lower, so much short interest. I don't know if you remember, we had that survey from the bull bears from Bank of America, and very pessimistic, right? I mean, it was way over into everybody thinking the market's going to go down. And these are, a survey of professional investors. And so when you see that, often you'll see the other direction, mainly because, again, people are shorting the market, thinking it's going to go down, and then they have to cover those shorts. And when they cover shorts, they buy them back, and it creates an up run, and you kind of get this panic, buying. So I think that's really interesting. And then if we look at kind of the S&P 500 here, you can see it's a pretty incredible looking, tail there that's happened at the end. So this goes, the very peak on this chart was back in January 3rd of 2022. It's the very beginning of the year, all-time high for the S&P 500. And, we hit a low last year, October 13th on the S&P 500. And we've been kind of crawling up until July. And then we had a 10% drop from July to the end of October. And now we've had this big jump. And so we've managed to accomplish some things here. We've turned the boat from negative, primary direction to positive. We've managed to maintain that positive direction with this move here that's happening. And even in this little trend here. So we had a little downtrend with 3 highs that were all lower. So the danger was we were starting to establish a new overall downtrend. And that was a real issue that could be happening. But obviously we broke through that. We then established a new high that was higher than a previous high, which we hadn't done, since July. So that's good. And as of today, as we're sitting right now, the market hasn't closed yet. Maybe it has. It actually, well, by the time the show's over, it'll be closed. And, we've exceeded the high, the second high there. So we might close above that. And if we had a checklist of wishes and desires, love to see it get above the high that was established for this year, which was the end of July, specifically to see that before the end of the year, get a new high. We're within striking distance. I wouldn't be surprised to see that happen just because there's so much momentum here. I also wouldn't be surprised to see the market take a rest here.
Yeah.
And I've been saying that actually for about 4 days, and it hasn't happened. It keeps, even if down a little bit during the day, it'll end up by the end. Not a lot. The pace of change has definitely slowed down. There's a couple divergences on my charts where, the new highs that we're getting, we're not seeing the same highs on some of those indicators. And then we're also seeing, a stretch where the RSI is hitting up against 70, right? Which gets above 70 on the RSI 14-day basis. Oftentimes you'll see some pullback. Below 30, you'll see some run-ups, which is exactly where it got to I think at about to 828 on a close basis at that bottom at the
Yeah,
end
a
of
lot of
October.
technical traders start to take their
Yep.
profits when they see these divergences.
Yeah, see divergences, see stretch, and so I wouldn't be surprised to see. We're not going to go. In my opinion, we're not going to go straight through to the all-time high for the year, right? Or for the whole market, for that matter. There'll be lots of bumps and turbulence along the way, but a lot of this has to do with some very fundamental pieces, and we'll show some other pieces here too. But where inflation is getting better. And the Federal Reserve has last rate increase was July.
Yeah.
The last meeting sounded like they were looking at the possibility of not having more rate increases, at least a little.
Yeah, and the watch tool has now gone to 100% for no raises in December and January.
Yeah, so this is a pretty cool tool that comes out. It shows the futures market for what the expectation is for what the Federal Reserve is going to do. And neither one of us has seen it at 100% before, up into 99 point something. So it's actually at 100% probability that we will not have a rate increase at the next two meetings. And so the meeting, December and January, then there's nothing in February. The next meeting will be March. And actually the tool right now shows a decrease in rates by May, would be the projection. Now, the Federal Reserve is a group of humans. They're going to decide what they want to do. Handicapping what they might do is difficult at best. Although I will say that CME tool has been a little bit more accurate as what's actually happened than what the Fed has said is going to happen or projected that was going to happen. So we'll see how that plays out. But the last thing on the checklist, of course, would be to get to this new all-time high. I would be very surprised to see that happen this year. Just not enough time left this year. But we're not that far from it. I think that's like 5% above where we are now. So it's possible. But what happens is you get to these highs, like right now where we were a high, those become kind of resistance points. And it takes a little while to get through those, maybe a backup. And this is assuming it's going to continue upward. It doesn't normally go, if you look closely, on a straight line for very long, right? There's generally some profit taking. There's a lot of people that are in the market for short periods. We're not one of those per se, but looking at it by day. So of course, this is a great chart. This is the fund management survey. So just in this month, this shows how much overweight or underweight the fund managers are based on this survey compared to their targets for how much should be in stock. So when you see that blue blob above that line, that means they're overweight. They're, so if they're at 60% is their target, maybe they're at 65 or 70 or whatever. And the blue blob below that means they're underweight. And you can see that they've been underweight here from 22, 23, pretty substantially. So they finally just went to just slightly overweight, right? Maybe more or less back to where their, target weight is. If you look closely at this chart, you'll notice that every time it's gone from underweight to overweight, it's gone overweight quite a bit. I mean, it's kind of, there's a lot more blob on the top of that line. And so there's some more money potentially on the table that can come in from big sources. We're seeing similar things, in terms of money on the sidelines with retail investors, other institutional investors, because this is fund managers, there's pension managers and, all these things. And so I think, this shows some power. It shows why we're seeing these gains, because that money's coming in, right? These are the ones that move the market. The retail investor, interestingly enough, never used to really, they call them the small lot or odd lot investors or what have you in the day, way back. They never used to have that much impact on the market. It was always focused on the institutional investors, of all types, because that's where the big money was. And that's still true. But in 2020 and beyond now, we are seeing the retail investors have some more impact because they're using options. And so they're able to take a dollar amount and magnify their impact on that stock by using an option. Now, it's a pretty crazy way of investing. You can make a lot, lose a lot. But nonetheless, we are seeing some more impact from that group now than we used to, which I think is a good thing, because you need, the institutional investors are always kind of locked into the past. They're all looking at, what happened in the 70s, and, we all know the history. And sometimes people that just need, they just like the artificial intelligence or whatever it is, clean energy, and they want to, ride that wave, and they create that wave in some sense too. So now this is kind of interesting here. One of the things that we've been talking about this a little bit over time is that the bond market was not participating in this rally all year. We had a little run up at the beginning of the year, and it gave it all back, and then we sold off. And I just read an article saying that non-U.S. holders of treasuries in September sold a net of $1.7 billion worth of treasuries, mainly China and Japan. And so if you look at like September, October, pretty bad months for the bond market.
Yeah, they missed out on that rally.
They sure did, but they're probably doing it for other purposes. There's all kinds of things politically, whatever it might be. And so now we're seeing a nice rally. Yeah. Mm-hmm. And if you look at this chart, this is from Morningstar. It just shows last year what they expected in total return per year over a 30-year period out of different categories versus this year, 2023, which is in the blue. And most of them are pretty similar, but there are projecting, the biggest difference on this chart is the projection for higher rates of return from bonds.
Yeah.
And we've certainly seen that. If you have some long-dated bonds in this last several weeks, you're probably up a lot on those too, just because they had sold off so much in September and October. But they're projecting that value is going to outdo growth. I've been seeing that projection for years and years. It has not worked out to be true, but this is over the next 30 years. Yeah. So that's a different look than, hey, the next couple of years. But I think that's kind of fascinating. I think it's just something to watch for. We're reading lots of articles that the big hedge funds and what have you are really playing in the long bond market arena because that's where they feel the returns are coming from. So it's something to look for. And we moved into some long treasury bonds, some of our portfolios, 3-4 weeks ago. And
yeah, I've been seeing articles about hedge funds getting into long-term municipal bonds that have been kind of oversold by the individual investor.
Yep.
They're seeing an opportunity.
Yeah. Yeah, the irony with bonds is that the people that own them, even for us, they're the safe haven, they're the safe asset, and that to watch them deteriorate, you've got a group of people that are, less accepting of risk. Mm-hmm. And so when it starts to deteriorate, they're more likely to sell. And so you have the foreign selling going on. You got the Treasury and the Fed, basically dumping bonds. Also, the Treasury selling to basically get money to pay the deficit. The Fed is trying to get them off of their balance sheet that they accumulated. There's a whole lot of sellers out there. So you got panic, bond risk-averse people, and structural issues within the government, and then the non-U.S. governments too. So a lot of headwinds for bonds, but a lot of those are kind of structurally taking care of themselves slowly but surely. And I would pay attention to the bond market personally. I think there'll be something there. And if you have bonds and you've been worried about them, they're doing a lot better now. And they're really kind of right on track to where they were prior to the pandemic in terms of if you look at the Vanguard Total Bond Market Index. So I think it's just something to watch. Now, of course, one of the big things that happened, start with this. One of the things that's very interesting about this chart, it shows the interest rates on U.S. bond debt, and basically you can see going back to 2008 here, we've had a phenomenal lowering of interest rates all the way through up until 2022, the very beginning of 2022. And it's a pretty dramatic increase, right? Looking at that chart, that's a long period of time, right? From 2008 to 2023, and this is what's causing so much trouble with the market. And this is why everybody thinks we're going to have a recession, because you can't have that type of interest rate change historically without recession.
Yeah, because a lot of companies keep refinancing their debt because the interest rates kept going lower, so they just never worried about it.
Right. Yeah, exactly. And so, however, when I look at this chart, one thing I see is, first of all, we're at, almost 5.5%. That's pretty much an average, right? I mean, yeah, it's been a big jump back up, but we've been higher than that before. Some of those markets were fantastic. 2009 was the bottom of the 2008 downturn. We had great runs really all the way through in this time period from 2008 to 2020, end of 21. Other than the pandemic, that big 35% drop, which we recovered from very quickly thanks to all this government money that came out, that was a phenomenal run time frame. But rates were coming down, so we'll see what happens here. It's something to watch for. And of course, here's what they're trying to do, which is lower the inflation. Mm-hmm. So this is the consumer price index. There's two big baskets that the Fed, talks about: consumer price index and they really favor PCE, Personal Consumption Expenditure Price Index. But this is what was reported this week on Tuesday. And the market jumped really hard on Tuesday. Actually, it was a green shirt day. And what you can see here is that it kind of peaked out, and this is total top line inflation. It peaked out, it came down very nicely. And then at the end of July, which is where our market peaked for this year, it started to come back up because oil prices were coming up, right? And so the market dropped 10% in the same time frame that this thing was going up. So if you really want to pay attention to what's happening to the market, you probably need to pay attention on what's happening to this overall inflation. And certainly oil is one big area, right? Because that's what scares people. If we look at core inflation on the CPI, where they take out oil and food, kind of more volatile aspects, this is what the Fed tends to look at more. You can see the trend is pretty nice. It just continues to come down. That's exactly what we want. But again, I don't know that the Fed is looking at core. As an investor, you might be wanting to look at this top line inflation, because this is relating to me more to what's happening in the market. As that started to come down, we've seen this big 3-week jump. As that it started to come up, we saw a big 3-month slump. So definitely interesting as far as that goes. And this is kind of neat. This is sort of, I know you can't see this very well, but if you just look at these colors, these are the segments that the CPI is broken down into. If you pause this and probably zoom in, actually, maybe change the view here so we can see it a little bit better. That's better. What this is showing is red means that that particular segment, category that CPI is looking at is actually up. The more red, the more it's up. And of course, the more green, the more it's down, right? And if you just look, and this goes back in time, so I'm on the side of the more current time, and Easton's on the side of the more, in the past, November of 2022. It's pretty obvious. I mean, look how many oranges and reds there were, a year ago, 6 months ago, versus how many greens and yellows there are now, right? And so it's kind of across the board. And then if you want to study this, you can see the weightings, right, of what really matters. What shelter as a whole is 34.9%.
Yeah.
And that's where, if you spend some time looking at that, that's the part that's had the hardest time kind of coming down, or slowing down.
Like, even if you look at it now, it's at 0.33%.
Right.
So it's still maintaining it versus what compared to the rest of the market.
Yeah, and of course CPI is famous for its kind of strange way of looking at shelter from an inflation standpoint, because they have it right here, owner's equivalent rent of residences. So they basically try to determine, what you would pay in rent if you were renting your place instead of owning it. And they do it on a sampling basis. They rotate through different places. It's kind of interesting. And it's one of the reasons why the Fed actually doesn't like the CPI as much as PCE. PCE has, I think, a more robust look at, inflation as a whole. But it's still kind of fascinating. I know that costs are still going up, but they're going up at a slower pace than they were. And this rate increase and that big jump we saw in rate increases, from 2008 to now, this is the impact of that, and it's working, right, at this point. Now, what you want to see is slowing down, but not slowing down too much, right? And so that's the soft landing. That's what we're getting so far. Doesn't mean we'll stay there. That's the big question, and that's what people are worried about. So we'll see how that goes. But altogether, things are really good right now. Let's hope it continues, and we'll, be happy when things are going well. That's for sure. All right. So that was our summary for the week. Thank you for joining us, and really, look forward to being able to talk to you. So next week we will not have a show because it's Black Friday. We're trying to figure out what's going to happen the week after that at this point, but appreciate your time. Thank you.